There are several factors that will affect the foreign direct investment decision in Malaysia. Exchange rate is one of the main factors that will affect the foreign direct investment decision because it has a very large impact on the capital invested. The capital holder will not choose to invest in a country which has a strong currency because it will reduce the capital value of the investment. For example, when the exchange rate of Malaysian ringgit and United States dollar is 4 ringgit to 1 USD and 3 ringgit to 1 USD respectively. In the first situation, which the exchange rate is 4 ringgit to 1 USD, if a US firm invests in Malaysia with the amount of 100,000 USD, the firm can acquire RM 400,000 of capital. In contrast, if the Malaysian ringgit appreciated against the United States dollar and the exchange rate is 3 ringgit to 1 USD, the amount of capital 100,000 USD, which converted to Malaysian ringgit that can be used to do investment in Malaysia, is only RM 300,000. From the above situation, appreciation of Malaysian ringgit will reduce the capital value of investment. Therefore, high currency value discourage foreign direct investment by the capital holders. The foreign investor prefer to invest in a country which has a lower currency value because it brings the investor a higher wealth position and a lower cost of capital. Inflation rate is also a factor that influences capital holders' decision on foreign direct investment because it is the indicator of economic stability of the country. A high inflation rate indicates a low economic stability. Therefore, a country which has a low inflation rate will attract foreign direct investment into the country. This is mainly because a low economic stability increases business risk, which the investor may face losses. When the inflation rate is high, the prices of goods and services will increase. The consumer will need to spend more money to buy a similar product compared to a low inflation period. When the prices of goods and services increase, the demand of goods and services will drop and therefore lead to decrease in sales volume. Besides that, the cost of production will increase as well. For instance, RM 10,000 ringgit can be used to purchase 1,000 kg of steel as raw material to produce cupboards before inflation. During the inflation period, with the same amount of money, the business can only purchase 800 kg of steel. As a result of increase in the production cost, business is forced to increase the selling price of their products. This will cause the demand of products to decrease and directly affect the business profit. When the business profit drops, the return of the investors will be decreased as well. Thus, inflation rate has a very large impact on the business profitability. So, it should be considered by the investors before investing in that country. Capital holders will prefer to invest in large expanding markets which has a greater purchasing power so that they can gain profits from the investment. Small market size indicates that the purchasing power and demand for goods and services of the residents in the country is low. Thus, there will be less opportunities for the foreign investors to grow business into small market due to inefficient utilization of resources and capitalization of economy of scale. Firms take advantages on exploitation of economy of scale so that they can reduce the production cost by increasing the level of production. For the small market size, it prevents the firm from gaining such advantage. This is because the demand for product of the small size market is low, so that the firm is not able to produce a large quantity of product and therefore unable to reduce its production costs. It will lead to the fixed cost per unit increase when the quantity produced is small. Therefore, the smaller the quantity of product is produced, the higher of the cost of production will lead to diseconomies of scale. When the cost of production is high, firms are unable to earn more profit Because of this, the risk of the foreign investors to invest in small market-sized countries has increased. As a result, market size has a large impact on the capital holders' decision on foreign direct investment. The market-oriented economy and also the pro-business government policies of Malaysia are the main reasons that attract foreign investors to bring in their capital into the country. Malaysia's investment policies are quite lenient, so that it attracts a lot of foreign direct investment. For instance, the liberal equity policy allows the foreign investor to hold 100% equity in all investments of new projects and also investments of expansion or diversification projects by existing companies. Another investor-friendly policy, which is employment of expatriate policy, allows the companies which have paid up capital of 2 million USD above to employ up to 10 expatriates. Execution of this policy enhanced the confidence of the foreign investors to invest in Malaysia. Furthermore, Malaysia has been ranked as 22nd in the World Competitiveness Yearbook 2018 in terms of ability to create and sustain a globally competitive business environment. Malaysia has overtaken economies such as New Zealand, Japan, Italy, Russia, and India. Malaysia is one of the members of World Intellectual Property Organization. Besides that, it is also signatory of Berne Convention and Paris Convention, which govern the intellectual property rights, such as patent and copyright. In addition, Malaysia is also one of the countries which has dedicated agencies functions to enforce and oversee intellectual property laws. As a result, it encouraged foreign investors to bring in capital. The Malaysian government has established Permuda in year 2007 to simplify and streamline the process of obtaining business license and permits. By doing this, Malaysia has a better business environment. Permuda helps to improve the license application process by establishing online one-stop centers for business licensing, new company incorporation, and simultaneous registrations. It allows business to take a maximum of 100 days only to get a construction permit. Compared to previous, it is time-saving and convenient. Due to the ease of doing business, it attracts more foreign investors. Malaysia is offering a wide range of attractive tax incentives to promote our country as an investment destination by attracting more investors. Pioneer status and investment tax allowance are the main tax incentives offered by Malaysia. Companies which engage in the promoted activities stated under the Malaysia Promotion of Investment Act 1986 can apply for the pioneer status. The benefit of applying pioneer status is getting tax exemption of 70% to 100% of the statutory income for 5 to 10 years. Besides that, the unabsorbed capital allowance and accumulated losses can be carried forward. There is another choice which company can apply for investment tax allowance to get allowance of 60% to 100% on the qualifying capital expenditure incurred within a period of 5 to 10 years.